All right. So the Bank of Canada just cut. We obviously knew this was going to happen. Shouldn't really come as a surprise to anyone. The more interesting part about the cut today was that the Bank of Canada sort of signaled that they're likely done cutting for now. And that could change obviously based on data that we get from what the FOMC does today. I mean, a lot of people are expecting the Federal Reserve's going to cut rates and they might have a little bit more downside, which could give the Bank of Canada a little bit more runway. But most economists were of the expectation that the Bank of Canada would continue their rate cutting cycle after this meeting. And them signaling that that's not the case is an interesting change of direction. And it goes a lot with what I've been mentioning on this channel, where we've looked at a lot of rate paths over the past little bit and sort of what the bond market's doing, and that there isn't maybe as much downside to rates as a lot of people thought, that we would start seeing them flatten out or even maybe move up towards the end of next year. Now, what the Bank of Canada does on rates is, from my perspective, really a small piece of the puzzle. I think what is more important on today's announcement was their monetary policy report release. They release this 4 times a year. I try and cover it every single time they do. And so I'm just going to get right into this one. I took the time to read it so that you don't have to. This really gives me an indication of what the Bank of Canada is paying attention to right now, what research they're doing, what data points they're paying a lot of attention to determine what the right next move is. The first chart that stood out to me here is that they observed a decline in exports and it pulled down GDP in the second quarter of 2025. Talked a lot about the impact of a trade war and the pending further impact of the renegotiation of the Canada-USMCA trade agreement over the next year. And I think that this is probably one of the biggest headwinds for Canadian real estate. It's the biggest headwind for employment in Canada. And I'm going to get to a little bit more of why. But the further this negatively impacts our GDP, the more this could kind of weigh on any potential for price recovery that we're hoping for in the Canadian real estate market. Consumer spending, so spending and even spending on an individual on an individual basis, continued to increase. So this tells us that consumers aren't really as tapped out as we maybe thought they would, or inflation is so significant that it's actually making us have to spend more money just to survive. Housing activity did move up from recent lows, according to the Bank of Canada, which we can see from an activity perspective. We know that more transactions are taking place in the real estate market right now. Nobody's really arguing against that. And if they are, they've just been wrong. What most people are arguing against is that prices are going up, and prices aren't going up in the markets that matter in Canada, and at a national level, they're not really moving up. But the number of transactions is moving up. Tariffs are obviously continuing to weigh on exporting. So again, this is going to have downward pressure on GDP. And we've heard Carney talk a lot about how we're basically trying to export more to countries outside of the US, but the US is such a massive trading partner. That's a huge gap to try and backfill for. And it's not going to be easy work for the government to try and find more trading partners to fill this massive hole that could happen as a result of the trade war with the US. As a result of all of this stuff going on, the labor market has weakened quite a bit. So slack in the labor market has increased, and the labor market is especially weak in sectors that rely on exports to the US. So your auto, manufacturing, et cetera, where we're seeing tons of job losses take place, and employment growth in Canada is weakening. Again, you can't grow your real estate market if people are losing jobs and if people's wages aren't going up. So this is the big headwind for Canadian real estate right now. Usually the final down leg that you see in a recessionary or housing cycle comes from the employment level falling, so people losing jobs. All of that being said, wage growth is still around 3%, a little bit above inflation. And so eventually, as we start thinking about price recovery, that wage growth is what's going to drive it. It's going to take a long time to get. Inflation did rise in September, and this is probably one of the reasons why the Bank of Canada is sort of potentially slowing down with the cuts until they see further data that indicates that Canada's economy is cool enough for them to continue cutting. And this is an interesting chart I've brought up a couple of times here, but they show shelter services inflation. And the big one here is that rent is blood red. And we all know that rent is falling. And so one of the big reasons, and Ben Rabideau sort of observed this on Twitter already, a big reason why the Bank of Canada is comfortable cutting with inflation where it is because basically that huge portion, that shelter inflation portion, 27%, is not really a proper reading. And especially the rent, which is 7.4% of total inflation, is not really a proper reading. And so there's probably a comfort level with the Bank of Canada knowing and understanding that there's not a ton of risk that there's super persistent inflation, at least from those sources. On the inflation side, obviously central bankers and analysts pay a lot of attention to core, and core is still elevated. It's not moving up anymore, or the upward momentum has sort of slowed quite a bit. But core inflation is actually what the Bank of Canada would be paying the most attention to when they're making their rate decisions, and still higher than where you'd want it to be to consider further cuts. From an inflation expectation perspective, businesses' inflation expectations have declined while consumers' expectations haven't really changed. So forward looking, there might not be a lot of risk that because the central bank does always want to pay attention to what people are thinking is going to happen with inflation. Bond yields have come down quite a bit, especially with activity in the U.S., both Canada and U.S. on the 2-year bond yield side of things. But the 5-year seems to be pretty sticky. I'm interested to see what happens in November when the budget comes out on the bond yield curve in Canada. That to me is one of the biggest things because the government is going to need to issue a lot of bonds to finance this huge deficit spending they're planning to do. And your equity markets, S&P and TSX, obviously are still ripping to new all-time highs almost every single day. The assumptions that the Bank of Canada made around tariffs when they're originally modeling all their pass-through scenarios and economic impact scenarios is a lot more severe and a lot bigger than they originally anticipated. So this is obviously going to have a lot of impact on their decision-making process moving forward. The Bank of Canada obviously does expect GDP growth to strengthen, but the level of activity is lower than projected in their report in January of this year. This is alarming from my perspective. I don't. I think maybe we'll just see a bouncy GDP. Some quarters you win, some quarters you lose. But I think overall we're in like kind of a period of economic contraction. They expect GDP growth to average 1.4% growth in 26 and 27. Again, I think you're going to see it could happen, but you might see some quarters where we lose, some quarters where we win. I think a lot of this is really dependent on what happens with the trade agreement negotiated with the U.S. and how quickly we can get out of this sort of battle on the trade war and stop losing jobs in key sectors in Ontario, especially to the U.S., especially the auto sector. I mentioned earlier that consumer spending is still high. Their expectation is that consumer spending will slow pretty significantly. So this is when you get to the point where all those job losses, all that economic contraction actually has a knock-on effect of slowing the remainder of the consumer economy. And that's where you see like retailers start to suffer, warehousing, et cetera, and it starts to push through the remainder of the economy. They do expect business investment to pick up slowly, but residential investment has been hampered by supply constraints. And obviously they project inflation to be where they want it to be for the next couple of years. They did do a lot of good analysis on the impacts of the trade war, especially comparison between U.S. and exports from China. Obviously, this is a big thing that the Bank of Canada is going to be paying a lot of attention to. They think that the path of U.S. GDP growth is going to be a lot lower than it was in the past. They compared their economic growth projections, their October versus January, and I find that most of their October projections are a little bit lower. On CPI, they are expecting the readings to be a little bit lower. The big risks they evaluate, the big one is obviously whether or not they can keep inflation within that range, especially with a lot of these cost push or knock-on effects of tariffs being persistent, but that the current price pressure suggests that inflation should be able to stay around 2 to 2.5%, which is where they want it, and that the cost pressure they originally observed on goods seems to be easing a little bit, which should take a little bit of the pressure off of inflation, but that shifts in trade are adding a lot of new costs to Canadian businesses and eventually Canadian consumers who those get pushed to. And it seems like we're sort of hitting a limit in where those businesses can actually start passing those costs on to consumers, where fewer businesses than in previous quarters are planning to pass those trade-related costs increases onto consumers. So a lot of this tariff stuff, we might actually be at the end of where that push continues to be inflationary. And more businesses are expecting to hold prices steady, which means that they probably are realizing that increasing prices any further than where we have already might cause some demand destruction, which would obviously further negatively impact the Canadian economy. Anyway, all in all here, I mean, I'm not surprised. I obviously made this call a couple of times on what the Bank of Canada was going to do. I don't think you should be surprised either. The key question from my perspective is, are they actually going to stay at 2.25%, or is there more downside risk on or more downside potential on rates? Because as people in the real estate profession, this matters to us because people use mortgages. They depend on the interest rate to buy real estate. And if they can't do that, or if that rate is higher, then we don't necessarily have a recovery scenario in the real estate space. But let me know what you think in the comments, and thanks a lot for taking the time to watch this video.